How much are things like this really worth? Or how much is this here worth? If you're considering to buy gold, it's better to do this in smaller quantities. Then it's easier to get this across borders in case you have to. We don't know what's really happening during times of crisis. And that's really why we are buying gold, right? We're not just buying this for investment. We also buy this as an insurance in our portfolio. When times get really tough, when the financial system collapses, we've got something to hedge against that. Now, this video is not about the process of buying physical gold. This video is about the price performance of gold. Is gold already too expensive, or should we still bet on the current rally? We're going to look at data most people are not considering. Because here's the good news. There's a new report published by the World Gold Council, and we're going to look at the different data points, at the different charts that are presented in that report that might give us an idea of what's currently driving the price and how sustainable the current rally might be. Here is fundamentally what I think matters. If the gold price is mainly fueled by central bank buying, that's good, because central banks have a very long time horizon. When they are buying, they tend to just keep holding it. However, if the gold rally is mainly driven by speculative demand through ETFs from Wall Street, for example, and not through physical purchases, then that's a problem. The retail investor that buys gold for the long term might do so in physical form. The retail investor that's just speculating on the current rally might just go in and out with a very quick liquid form, as in with ETFs. So where the demand is currently coming from is useful, and the report answers that question. Let's have a look at this long-term chart. It starts in 2010. It's a split up by sector showing the quarterly demand. We can see in the last few months that the jewelry sector has reduced its demand. Gold became so expensive that there's less demand, at least measured in weight, for gold products. Technology keeps its current demand roughly, but have a look at this, right? We've got the ETFs that bought more. That's the dark blue area in the last 3 quarters. So here's a zoom into the jewelry demand. Again, this fell quite rapidly in the last 3 quarters. So it's obviously not the purchases through jewelry that's pushing the price. That's also not the official narrative. The official narrative is that it's central bank purchases that moves the price. But is that true? Here is the gold ETF demand over time. The last 3 quarters have been incredibly strong, not as strong in terms of tons compared to the beginning of 2020, but still, despite the price going up, the demand in weight is consistent. So the dollar inflows through the ETFs grow as quickly as the price does. Here's the demand for physical gold. This time it's an annual chart, so it just looks at the first 3 quarters of every year. There's a slight increase in tonnage here, but not enough to justify the rally. Yes, India and China is buying more, but other regions have slightly slowed down their demand. What about central bank demand though, and the idea that China is now scooping up all of that gold? The issue is that the China demand is not officially published. So what we are getting from the gold report is just the official numbers. And they are frankly not convincing. We see again Q1 to Q3. So this report covers everything until the end of Q3. We don't know, of course, what happens in the last quarter of this year, but we can compare the numbers. And again, the central bank demand over the last 3 years tended to rather decline in terms of tonnage. Yes, 2022, 2023 and 2024 in total had kind of comparable total demand. But if you just look at Q1 to Q3, so the dark blue bars, this is not necessarily a data point we would expect given Bitcoin's rally and given the official narrative. This again comes directly from the World Gold Council report. If you're enjoying this video so far and you're getting some value out of it, then feel free to give this a like. It will help the channel grow. It will help spread the word. Thank you very much. What countries are officially buying? Poland apparently is the biggest net purchaser. China is only at number 4 with a bit over 20 tons. Now, how much is 20 tons? We're going to look at this in a second. Here is the global annual supply. It's somewhat steady. It has risen slightly over the last years. But have a look at this. Year to date, we have more than 2,500 tons that got mined. For the entire year, we reached somewhere around 3,500 tons. So the official demand that China is publishing is really not significant at all. But maybe we can ride the current momentum. Obviously, currently the price is going up. It's reaching new all-time highs regularly. So maybe we just jump on that rally and then sell once the trend turns around. That is a potential approach. The question though is, what do we regard as a turnaround? When gold went from 2,000 to 1,600, should we still keep on holding? Or when gold went from 1,800 down to 1,100, is that a turnaround of the trend? It's very hard to time this properly. So really, I'm more a fan of figuring out the fair value. The US dollar valuation of gold, of course, over time goes up, and that is because the monetary base expands by roughly 6.8% per annum. This is USM2. So over the last 66 years, this grew on average by 6.8%. There's now 77 times more US dollars floating around compared to 1959. And the growth rate is quite constant. This is now the same chart on a logarithmic scale. And so really what we should be looking at is the gold price relative to USM2, relative to the monetary base. If there was no inflation in the US dollar, if the US dollar base wouldn't expand, what's actually the gold price? The average gold price is here, this dotted line. Again, this chart starts in 1959, and we are currently above that historical average by roughly 55%. But is there a chance that we could go to all-time highs? That the gold price could still outperform monetary debasement by roughly 200% and hit the peak that we saw at the end of the 1970s? I've got my doubts, because what we compare over here is the gold price relative to the monetary base. But what's probably better is to compare the gold market cap relative to the market cap of the US dollar. Because again, there is gold mining every year. And that gold mining is around 2% annualized over that time period. So if we take the 46 years, so from this point over here to this point over here, and we assume an underperformance of 2% per annum because of the gold supply expansion, we should expect the gold price to decline by 60% over that time period. Or in other words, the gold price will not keep pace with the monetary expansion long term because there is the 2% mining. It will not appreciate by 6.8%, as does the US dollar base. It will rather appreciate by 4.8%. That should be our expectation. If there was no gold mining, of course, we'd see 6.8% price appreciation long term. But because there is, we should expect less. And over 45 years, that adds up to a loss of 60%. And just have a look at this. From the top at the end of the 1970s to today's price, we went down by close to 60%. So this top over here aligns perfectly with this top over here if we didn't plot the gold price, but the gold market cap relative to USM2. I don't have the gold market cap in TradingView, so unfortunately I can't show this properly. But this decline here is exactly the decline we should expect, given that the gold monetary base is just going up slower than the US monetary base. And so I'm not convinced that we're going to see $10,000 per ounce of gold. I rather think we are now at the top. I've personally sold the vast majority of my gold ETFs. Again, because this official story, at least, that it's central bank purchases that's pushing up the price is probably not correct. It's probably mainly speculative demand through the ETFs. Of course, I cannot look into the vaults of China. Those are the official numbers. And maybe there is a grandiose plan to dump on the US dollar and replace long-term treasuries completely with gold. But I'm not sure if the gold market can even absorb that much demand. China has a trade surplus per annum of roughly $1 trillion, and the gold market cap is $28 trillion. By the way, Bitcoin's market cap is $2 trillion. I think it's better to take some chips off the table. I think this rally might be coming to an end. At least historically, we are at extremely high prices relative to the monetary base. I still think it makes sense to hold some physical gold just in case things totally blow up. There is a case to be made to have 2, 3, 4, 5% of net worth in physical gold, but probably nothing beyond this at the current price levels. I don't think it makes sense to have 20, 30% of net worth now in gold, because again, the price is already very, very elevated, and it seems like it's retail demand, speculative retail demand through the ETFs that's currently pushing up the prices. If it's your first time here, feel free to subscribe. I publish here regularly. A like would be very much appreciated as well. It helps the channel grow. See you next time here on YouTube, or potentially see you in premium as well. The link to premium is down below under this video. Cheers.